Hi, in this video, I want to share with you a case study. So how you can earn high yield with very little risk as a private lender. Okay, so many people ask me, so how does it work? And I just want to show you the numbers, how everything is going. And I hope it's going to be clear by the end of the video. Okay, so I recommend you just for something you need to stop this video, maybe use your a calculator or loan mortgage calculator just to see how everything is going. So there's going to be a lot of numbers in this presentation. So I just want to give you a very simple scenario, and I can see this scenario all the time, okay, from our point of view. Okay, so let's take this land. It's 8 acres in Texas. So the value of this property is 120, okay, like 118,500, and the current loan balance, okay, is 80,000. Okay, so that's the current loan or lien against this property. The loan it was originated at 9% for 240 months. Okay, so the monthly payments are 719. So the borrower that purchased this land every month is paying 719. So we are getting those deals all the time. So I was able to purchase this property for 64,000, and I was able to get 12.34% yield because I paid a low price. I got an instant equity between the 80. I got like 60,000 as an instant equity deal. Now you probably ask yourself, so why would this person that owned the note, why gonna sell the note to you, and why gonna sell the note to you at such a big discount? So again, first, those sellers that can be like banks, lenders, or they can be like investors. So with banks, sometimes they have too many loans, okay, and very little cash on their reserves. So they have to maintain a certain ratio. So they have to liquidate some of the loans, okay, outside. Sometimes they sell to investors, to hedge funds. And it doesn't mean they are selling the garbage. It's not, doesn't have to be a garbage. So they are selling some loans just to balance the ratio between the deposits to the loans. And some investors, what they do, they just buy and sell. That's what they are doing. That's very good at. They are sourcing a product of the market and selling to the market. And sometimes they're using seller financing, owner financing as a tool. But they're not in the loan space. They're not in the lending space. So they just want to liquidate the loan and buy more land. Okay? That's what they do. Okay? And they understand that the value of the money, there is a time value. So they can't pay for a future payment. That's how it works. Okay? So I hope it makes sense now. Now, for every loan, there are 3 scenarios. So there are 3 possible outcomes for every loan. Okay? And the most simple one, pay as agreed. Okay? So again, the borrower is paying us because we are the lender now, the note investor. I'm the lender now, 720 for the next 20 years. So as I say, the yield going to be 1234. Okay, this happened before. Now, the second thing, what's going to happen? Maybe the borrower decide to pay off early. Okay? Maybe after 5 years, they want to move to another property, so need to sell it in the open market. Or they're selling, okay, the 9% they are getting, they are paying, right? They are paying 9%. That was the original loan. It's too high for them. And then maybe they have a good credit score now, and they have enough equity in the property. So they are going to a traditional bank or conventional bank and get a lower rate. So that's how we are getting paid off. But he's still in the land. So in this scenario, I got paid for 60 months, and so basically 43,186 after 5 months, and the loan balance of the 80,000, that's what was the original loan amount, is 70,965. So over the 5 years that the note investor owned the note, he got paid 114,000. He paid 64, and he got paid 114,000 over 5 years period. So the annual yield, the IRR, it's close to 15%. So that's good, right? So let's see what's the worst case scenario, right? So what's going to happen if they can't pay or they fail to pay because people have some things happening in their life, right? Divorce, medical issues, loss of employment. So let's see what's going to happen. So in the first 5 years, it's the same, right? So we got 43,000 because they paid on time for 60 months. It's 43. But now what we're going to do, we got the house back. So we have done maybe some foreclosure. So we went to foreclosure because there were no other way. Usually we don't like foreclosure. We don't want to put people out of their properties, even if it's a land in this case. But that was the worst case in here, and the note investor is dealing with everything. So we had to sell the property. So again, I assume that the value is still 120. It didn't go up after 5 years. And there are some selling fees. So there are agents fees, escrow fees, and some legal fees to do all the foreclosure. So in the end of the day, we got 150,000 over a 5 year period. So if you're going to punch it in a loan calculator, the annual yield is 21%. It's not bad, right? Again, all those yields, all those returns are for the note investor. This for the note investor. Just put the numbers here to show you what's the number for the note investor. Now I want to show you what's going to happen if the note investor, in some cases, so because they're getting lots of deals, what's going to happen if the note investor, okay, doesn't have enough cash to purchase this deal. So what does he do? He presents this deal to his private lenders and asks them if they have funds to invest together with them so they can share the profit. So let's use this scenario. The house is the land is the same, the loan is the same, but the private lender is okay. So now that the note investor is a borrower, is borrowing for the private lender $67,000. So if you remember, the private lender is paying 64. Sorry, the note investor is paying 64, but is loan 67,000 from the private lender. Okay. First, in most cases, what you need to do, you just want to put these funds in a reserve account in a case that the borrower, the landowner, not going to pay on time. So that's when you have this emergency fund. So they're not going to have some cash ratio. That's super important. So let's assume that the note investor using a private lender as a finance source for this deal. The private lender was happy to get 8% on his money. The term's going to be for 240 months, but in our paperwork, what they are doing, every 5 years, we're going to let the private lender exit their money. Okay? That's their decision. If they want to stay, to keep getting 8%, or after 5 years, they're going to say, okay, I had enough. I got my 8% every year. Now wants to go out. Now wants to do something else. Okay, that's okay. Because every person, some people's situation change. Okay, so that's their own decision. So every 5, so let's assume here it's 20 years. Every 5 years, they're going to have an exit point. So I had enough, or let's continue. So the private lenders is, again, paying $67,000 every month, is going to get $560. Now, let's see what kind of scenario is going to have the private lenders. So all the scenarios, like we showed before, pay as agreed, pay off early, and fail to pay, all the private lender are going to get the same amount of money all the time. So in this case, let's take 60 months from now. Okay, it's pay off early or fail to pay. Okay, so again, after 60 months, you got $33,600. And the balance payoff is $58,000. The balance after of the 67, because the private lender lends 67 after 5 years. Okay? If you lend the money amortized for over 240 months at 8%, it amortized, the remaining is 58. Hope it's clear. So you put 67, after 5 years, you got $92,000 back over time, every month. And so it comes to 8%. So for the private lender, doesn't matter what's going to happen, what scenario. You have only one scenario. You're going to get your 8%. Okay. Sometimes you're going to get your money early because the note was paid off early or the borrower failed to pay. Now I want to share with you a scenario. Now it's very important to understand. So the note investor, if he failed to pay, if he doesn't pay for 2 months in a row, the private lender actually is taking over the note. Okay, that's in the paperwork. Okay, the private lender is taking over the note if the note investor doesn't pay for 2 months, okay, or 60 days. Okay, there is no legal action here, and that's very important. So I want to share with you a scenario if after 12 months the note investor failed to pay, and what's going to happen? The private lender becoming the note investor, becoming the note owner. So let's kick out the private investor. Only the private lender here is in the deal, and of course the land owner and the borrower. So what's going to happen? You are getting your 560 times 12. So you got in the first month, in the first year, 6,700. Now, if everything is going as planned, for the next 19 years, you're going to get 720 for your money. So you're going to have 11.4% yield. Again, you came to this deal at 8%, but because the note investor failed to pay you, and in most cases, not going to happen, right? But I want to see the worst case for you. Note investor failed to pay, you're going to get 11.4%. Not bad, right? Now, let's go to the second scenario. After 60 months, the landowner decides to refinance or sell the property. So you got in the first 12 months, 700. And then in the next 4 years, you got 720 times 4 years, right? So you totally got 34,000. And then the balance of the original note, of the 80,000 note, is 70,965. So over time, you got 105,500 over the first 5 years. So if you're going to punch it in the cash flow of this money, okay, in IRR or any type of annual yield, you're going to get 40%. And that's not bad. Again, the note investor is not in the game already, and you at the private lender, that's what you're going to get. In the third scenario, it's very similar to the second one, okay? But in the third scenario, after 5 years, you would need to sell the house, pay agents' commissions, pay escrow, and pay an attorney to handle the foreclosure. Again, even if the note investor is not in the picture, the loan servicing company can help you with it. In worst case, they can maybe connect you with, put you in some contacts. And you're going to get 20.7% annual yield. Okay? That's pretty good. So that's why I like this strategy, this approach for the private lender. They are protected. So unlike in the stock market and the real estate market, your principal is not protected because you are investing in 100% of the property. So if something is value 100, you are investing 100. So your principal is it doesn't have any buffer. In here, you are lending, your ratio between how much you lend to the property value is very low. Usually I like to have 65% or less. Okay. So that's why your principal is protected. So you're getting your yield. And if something goes wrong, actually your yield goes up. Okay. Again, I just want to say what I just said. If everything goes as planned, you see here, your yield is the minimum. If things get worse, right? I'm not sure pay off early it's worse, but your yield goes up. Again, if you have any question about the numbers, about how you got to these numbers, just reach out to me or maybe put some comments here below this video. Okay, I'm going to try to answer your questions. If you want to learn how to be a private lender, like you just saw in the presentation, you would like to get those returns. Okay, again, we are aiming for 8%, but that's going to be the returns you are watching on the screen. That's the worst case. What's going to happen if everything goes bad? If you want to learn about it, there is a training on the passive retirement account. Just click on the link below on passiveretirementAccount.com and learn how you can be a private lender. See you soon.